I have spent years studying the patterns of financial markets, and one truth stands out above all others. Crashes are inevitable. Prices soar, optimism runs high, and fortunes are built seemingly overnight. Yet just as quickly, the tide can turn. Markets can collapse, leaving those unprepared with losses that may never be recovered. Benjamin Graham, the father of value investing, understood this reality better than most. His work, particularly in The Intelligent Investor, was born out of an era of tumultuous markets and serves as a guide for anyone seeking to navigate uncertainty. What I want to share with you today is not a formula for predicting the next crash, no one can do that, but a framework for surviving them. Graham's philosophy teaches us how to safeguard our capital, maintain rational judgment, and even uncover opportunity when the majority are paralyzed by fear. Consider the market as a vast ocean. On calm days, it is tempting to forget that storms are coming. Yet they always arrive, and only those who have built sturdy vessels and prepared for turbulence will weather the waves. In this analogy, your portfolio is that vessel, and Graham's lessons are the blueprint for making it resilient. Today, we will explore the principles that allowed investors in Graham's time to endure the Great Depression, the lessons that remain relevant during modern financial crises, and the strategies that can protect any investor from succumbing to panic or rash decisions. By the end, you will understand that surviving a market crash is not about luck. It is about discipline, preparation, and rational action. But first, to understand how Graham's principles were forged, we must examine his view of risk and market behavior. Benjamin Graham saw risk differently than most investors, even today. For him, risk was not the day-to-day fluctuation of stock prices, nor was it the fear of missing out on gains. Risk was something far more profound, the permanent loss of capital. Losing money because a company failed or because you overpaid for a stock that never recovered was the true danger. Short-term market swings, he argued, were largely irrelevant if you had a disciplined approach rooted in fundamentals. He introduced the distinction between two types of investors, the defensive investor and the enterprising investor. The defensive investor prioritizes safety and preservation of capital. They are cautious, methodical, and resist speculation. The enterprising investor, while willing to dedicate time and effort, must still respect the limits of risk and apply rigorous analysis to avoid catastrophic losses. Both types, however, are governed by one principle: never underestimate the potential for a market crash. He also emphasized the importance of psychological discipline. Markets, Graham noted, are driven as much by human emotion as by fundamentals. Panic can push prices below intrinsic value, while euphoria can drive them far above it. Recognizing these tendencies allows investors to act rationally rather than being swept up in herd behavior. Diversification, he argued, was the first and most important tool in managing risk. By spreading investments across multiple securities and asset types, investors reduce the impact of a single company's failure or sector collapse. Even if individual investments falter, a diversified portfolio can endure, allowing the investor to stay the course. To fully appreciate why these principles matter, we must look at the historical crucible that shaped Graham's thinking, the 1929 crash and the Great Depression. The late 1920s were a time of extraordinary optimism. Stock prices soared, fortunes were made overnight, and many believed the market had entered a permanent upward trajectory. Graham witnessed this exuberance firsthand. Investors poured money into speculative ventures, often ignoring fundamentals in favor of hype and the illusion of quick wealth.
Then, in October 1929, reality struck. The market crashed. Prices plummeted, banks failed, and panic spread like wildfire. Those who had concentrated their investments in a few high-flying stocks found themselves facing devastating losses. Meanwhile, investors who had diversified holdings across strong companies, different sectors, and bonds were better able to absorb the shock. They still suffered losses, but the damage was not catastrophic. The Great Depression that followed deepened these lessons. Companies that had appeared invincible suddenly faced bankruptcy, unemployment soared, and the economic landscape changed drastically. Graham studied these events meticulously, analyzing what separated those who survived from those who perished. It became clear that luck alone could not account for the difference. The survivors were disciplined, prepared, and focused on intrinsic value and margin of safety. This historical context illustrates a timeless truth. Market crashes are inevitable, but they need not be destructive if approached with rationality and preparation. By understanding how crashes unfold and recognizing the psychological pressures involved, investors can structure portfolios that endure even the most severe turbulence. Graham's teachings offer a blueprint for weathering market turmoil. At the heart of his philosophy are several core principles that remain just as relevant today. The first is the margin of safety. Every investment should be purchased at a price below its intrinsic value, creating a buffer against errors in judgment or unexpected market shifts. In a crash, this cushion becomes the difference between enduring a downturn and suffering permanent loss. Next is focus on intrinsic value. Graham advised that investors examine a company's assets, earnings, and long-term prospects rather than reacting to daily price movements. A firm grounded in fundamentals is far more likely to survive economic storms, making it a safer investment even when market sentiment turns negative. Diversification, as we have seen, is another cornerstone. By spreading investments across multiple companies, sectors, and asset types, the defensive investor reduces exposure to any single failure. Bonds and other fixed-income instruments play a stabilizing role, offsetting the volatility of equities and providing steady income. Liquidity is equally important. Graham cautioned against over-leveraging and stressed the value of maintaining cash or cash-equivalent reserves. These reserves provide flexibility, allowing investors to capitalize on opportunities created by depressed prices rather than being forced to sell at a loss. Finally, discipline and emotional control are crucial. Panic selling during a crash often locks in losses, while patient investors who adhere to principles of value, margin of safety, and diversification can survive and even thrive. These principles form the foundation for a defensive portfolio, which begins with preparing before a crash. Constructing a portfolio that can withstand a market crash requires careful planning, a steady hand, and adherence to Graham's principles. The first step is asset allocation. A balanced portfolio typically combines high-quality stocks with bonds and cash equivalents. Stocks provide growth potential, but they must be selected with an emphasis on strong fundamentals, consistent earnings, and reliable dividends. Bonds and other fixed-income instruments offer stability and predictable income, acting as a cushion when equities falter. Within the stock allocation, diversification is essential. Spread investments across multiple sectors and industries to reduce exposure to any one company or market segment. This strategy mitigates the risk of a concentrated loss derailing your entire portfolio. Another critical aspect is maintaining liquidity. Cash reserves or highly liquid investments ensure that you are not forced to sell assets at depressed prices during a downturn. These reserves also enable opportunistic buying when quality stocks become undervalued. Graham also emphasized portfolio simplicity. Avoid overcomplicating investments with excessive holdings or complex instruments that are difficult to evaluate. Quality and transparency are more important than quantity. Finally, a defensive investor must adopt a mindset of regular review and adjustment. Economic conditions change, and companies evolve. Periodically reassessing your portfolio ensures that it remains diversified, balanced, and aligned with your risk tolerance. With a well-prepared portfolio, an investor can face market volatility with confidence. Yet surviving a crash also requires psychological resilience. Graham's most enduring lessons is that surviving a market crash is as much a psychological challenge as a financial one. Markets are unpredictable, and human emotion often amplifies losses. Fear can prompt investors to sell at the very bottom, while greed can lead to overexposure during a bubble. The defensive investor must cultivate emotional discipline to resist these impulses. Diversification and margin of safety are not just protective financial tools, they are also psychological buffers. Knowing that your investments are spread across resilient companies, industries, and asset types allows you to remain calm when prices plunge. You are less likely to react impulsively because the structure of your portfolio reduces the likelihood of catastrophic loss. Historical examples underscore this principle. During the 1929 crash, panic selling led to devastating losses. Investors who reacted emotionally saw fortunes evaporate overnight. In contrast, those who adhered to Graham's principles, who focused on fundamentals and maintained diversified, conservative portfolios, weathered the storm. Their composure was as valuable as their capital. Modern markets present similar psychological hazards. Instant news feeds, social media speculation, and algorithm-driven trading can trigger sudden swings in investor sentiment. By internalizing Graham's teachings, preparing for volatility, maintaining discipline, and focusing on intrinsic value, investors can navigate these pressures, avoiding rash decisions and staying aligned with long-term goals. With emotional resilience in place, a crash can even reveal opportunities to acquire value rather than only causing fear. While crashes are terrifying for many, Graham viewed them as moments of opportunity. When fear dominates the market, prices often fall below intrinsic value, creating conditions for disciplined investors to buy high-quality assets at a discount. This is the essence of value investing: patience, analysis, and courage in the face of panic. During the Great Depression, some companies with solid fundamentals were crushed in price simply because the market sentiment turned negative. Investors who recognized the difference between price and value were able to acquire these businesses at bargain levels, positioning themselves for substantial long-term gains once the economy recovered. Modern markets reflect the same pattern. Whether during the dot-com bust, the 2008 financial crisis, or the COVID-induced volatility, panic often drives high-quality companies below their true worth. The defensive investor, guided by Graham's principles, can act rationally, analyze fundamentals, ensure a margin of safety, and invest selectively. Crucially, opportunity does not mean recklessness. Graham warned against buying indiscriminately during a crash. The investor must focus on quality, financial strength, and proven earnings, rather than chasing temporarily low prices in speculative or weak companies. Discipline and patience distinguish profitable opportunities from traps. Graham's teachings often run counter to instinct. In the midst of a crash, our natural impulses can lead to costly mistakes. One of the most common errors is panic selling. As prices plummet, fear tempts investors to liquidate holdings, locking in losses and missing the eventual recovery. Graham cautioned that selling under duress often converts temporary market fluctuations into permanent financial damage. Another counterintuitive lesson is resisting the urge to chase hot stocks. A stock that has already fallen significantly may appear attractive, but without sound fundamentals, it can continue to decline. The defensive investor must differentiate between a genuine bargain and a speculative trap. Graham's framework emphasizes buying companies whose intrinsic value exceeds the purchase price, not those simply experiencing temporary popularity or media attention. Over-leverage is another critical pitfall. Borrowing to invest magnifies both gains and losses. During a crash, leverage can transform a manageable downturn into catastrophic failure.
Graham consistently warned that maintaining financial flexibility is essential, especially when uncertainty is high.
Finally, impatience is a subtle but dangerous mistake. Crashes can last months or even years. Investors who abandon their disciplined strategy too early often fail to realize the benefits of their preparation. Graham taught that time and patience are allies, and that adherence to sound principles, even under stress, will ultimately reward the disciplined investor. By avoiding these common mistakes and embracing a thoughtful, patient approach, investors position themselves not only to survive a crash, but also to capitalize on opportunities. Though Graham wrote during the early to mid-20th century, his principles are strikingly relevant to today's financial environment. Modern markets are faster, more interconnected, and inundated with information, but the human psychology that drives market behavior remains largely unchanged. Fear, greed, and herd mentality still dictate much of short-term price action. Applying Graham's teachings begins with building a balanced, diversified portfolio. High-quality stocks with strong fundamentals remain essential, complemented by bonds or other fixed-income assets for stability. Diversification should span sectors and industries to reduce the impact of a single failure. Cash reserves provide liquidity, allowing investors to act opportunistically rather than react impulsively. Monitoring intrinsic value is equally important. In a volatile market, prices can swing wildly in either direction, but a disciplined investor evaluates companies based on earnings, assets, and long-term potential, rather than following short-term trends or hype. Tools like financial statements, debt ratios, and dividend consistency help maintain perspective. Emotional control is critical in the modern context. Rapid news cycles and social media can amplify panic, but Graham's principles remind us to focus on rational analysis over sentiment. Sticking to a well-constructed plan prevents costly mistakes and allows investors to act when others are paralyzed by fear. Finally, patience and preparation are the ultimate weapons. Crashes may be sudden, but recoveries take time. By maintaining discipline, following fundamental analysis, and adhering to a margin of safety, today's investors can endure turbulence and even emerge stronger. Benjamin Graham's guidance on surviving market crashes is not merely historical, it is timeless. He taught that markets will inevitably rise and fall, and that investors who ignore this reality do so at their own peril. Crashes are not anomalies. They are natural consequences of human behavior and market cycles. The defensive investor, Graham emphasized, survives not through prediction or luck, but through preparation, discipline, and rationality. Diversify holdings, maintain liquidity, focus on intrinsic value, and ensure a margin of safety. Avoid panic selling, resist speculation, and remain patient through volatility. These principles create a shield against permanent loss, even in the most severe market downturns. Moreover, crashes are not solely destructive. They reveal opportunities for those who remain calm, analytical, and disciplined. High-quality companies may temporarily trade below their true worth, presenting chances to acquire value at discounted prices. Emotional composure, coupled with a carefully constructed portfolio, allows the intelligent investor to benefit when others are overwhelmed by fear. In today's fast-moving markets, Graham's wisdom remains as relevant as ever. Instant information, social media speculation, and algorithm-driven trading may accelerate price swings, but they do not alter the fundamental truths of investing. By adhering to these timeless principles, investors can endure volatility, preserve capital, and pursue long-term growth. Ultimately, surviving a market crash is less about predicting the future and more about preparing for it. Graham's insights teach us that patience, discipline, diversification, and a focus on intrinsic value are not just strategies, they are a mindset. For every investor facing the inevitable storm of a market downturn, these lessons offer both protection and opportunity. Markets may fall, panic may spread, but a prepared mind and a disciplined portfolio endure. That is the legacy of Benjamin Graham, and it is a lesson that will never grow old.